Okay, so we have some questions here on valuation. These are generic questions, and it's best to answer this using examples. But let's just take a look at the question itself, and then let's just see how this is generally answered. So if you're asked what is the basic stock value, what is the basic stock, what is the stock value based on? What is the basic stock value based on? Sorry, what is the basic stock value based on a stream of future dividends? So how do you compute for the stock value? So this topic is all about valuation, valuating assets. Okay, how do you value a stock based on a stream of future dividends? So anyone? If you know the value of future dividends, for example, dividend for next year, dividend for 2 years from now, etc. How do you value that stock? How? I think you know fundamentally the answer to that. If you're given a stream of dividends, let's say for D1, for year 1, dividend for year 2, dividend for year 3, dividend for year 4, etc. Okay? Etc. So you're given the future dividends for next year, 2 years from now, 3 years from now, etc. How do you compute for the value of that stock? Well, that's very easy. Because if you have determined and estimated the future dividends, then you can just get the present values of that. Okay? The value of the stock based on dividends is called your dividend discount model. Okay, the value of a stock can be determined using future dividends, or it can be determined using free cash flows, which is a question in number 5. Okay, so if you know if you have the stream of dividends, estimated stream of dividends for the next years, you can just get the present value of this. In fact, you can just use the NPV function, right? And NPV function, because the NPV function allows you to get the present values of future cash flows. Okay, so that's very simple. Okay, how about what is the common stock value for a zero growth rate dividends? Zero growth rate dividends. So what does that mean? Zero growth rate dividends. Your dividend next year will be equal to your dividends. So it will be a constant stream of cash flow, D1, and then another D1, and then D1, and then D1, etc. So since this is zero growth dividends, then your dividends will just be the same all throughout. Okay? So unlike number 1, where the dividends may be different across the years, for this one it will be just D1. Okay, dividend over rate of return. All right. So yeah, okay. Yun ang formula doon, pero we'll take a look at that from from the Gordon model. Then how about if it's a constant growth rate? So your dividends is growing by a constant growth, let's say G. So if this is D1, then D2 will be based on D1 plus a certain factor G. And then D3 will be whatever your D2 is, let it grow also by G. Then D4 will be whatever D3 is, then let it grow by G. So this is what you call the constant growth model. Your dividends grow by this certain growth rate, constant growth rate G over time. And we make use of what we call the Gordon model to to determine the value of the stock. Okay, how about if it's a variable growth rate? So here you'll have G1, G2, G3, G4, etc. The growth rates are varying over time. Okay? So how do you now determine the value of that stock? And lastly, how about if you're using not dividends but free cash flow? Because aside from dividends, you can make use of the estimated free cash flow in order to determine the stock price of a firm. Okay, so we'll have an example of this, a distinction between dividend growth model and also free cash flow model in determining the price of a stock. All right? All right, by the way, what's free cash flow? What is free cash flow? Free cash flow is the cash flow available for distribution to the investors after after cash flow investments has been made on operating activities. So after you have set aside your cash flow requirements for operating activities, whatever's left of it can be flowed back to the investors. Okay, that's what you call your free cash flow. Free cash flow means cash flow available for distribution to investors. So it can be number one, what are the components of your free cash flow? It can be payment for dividends. Okay. Number two, it can be buying back your shares of stocks, the company's shares of stocks. Number three, it can be used for interest payments. Remember, as far as investors is concerned, there are two types. You have the stockholders and the creditors, the bondholders, those that lend money and those that invested in the company. So these are investors. So when we say free cash flow, it's the cash flow available for distribution to investors. When we say investors, they include stockholders and also creditors. So if you're asked what are the uses of free cash flow, as I mentioned a while ago, it can be used for payment of dividends. It can be used to buy back the shares of stocks, treasury stocks. It can be used to pay interest payments for creditors. It can also be used for principal payments. And number five, it can be used for investing in non-operating assets. Kasi the free cash flow is the cash flow available for distribution to investors after setting aside cash flow requirements for operations, for operating activities. Okay, so we'll have an example of this. All right, let's go to number 4. Okay, stock valuation. So you have this company, ATI. It has been growing at a rate of 20% per year in the recent years. Now, this growth rate is expected to last for another 2 years. Ang laki, no? 20%. No? Okay, so you're given that the dividend now is 60. The required return is 10%. Okay, so yeah, I think okay. So this is extraordinary times kasi, no? Kaya yung short-term projection ng growth for the next 2 years is 20%, just for the next 2 years. So the management believes that the next 2 years will be very robust, so they will be able to give dividends at 20% dividend payout ratio. So what are the expected dividend yield and the capital gains yield at this time? All right, so I gave here the formula. No? Expected dividend yield is simply your dividend at year 1 divided by the price at current price. Expected capital gains yield will be your expected return minus your dividend yield. Okay, let's answer some of this, and then I'll give you as an exercise to do some of this, and then we'll discuss and compare results on Friday so that we can cover the other materials. Okay, I will just, anyway, andyan naman yung formula, no? So you should be able to follow along. Okay, what I want now is for us to be able to determine the price now. The estimated price, the stock valuation, P sub O. All right? What is the estimated price of this stock given the condition that the current dividend is 1.6? And then it's expected that there will be a robust growth for the next 2 years. And then afterwards, there will be a constant growth rate for the next 3 years and following years. So the question is, what is the price of this stock given the expected dividends? Okay? What is the price of this stock? All right. So I'll give you a few minutes. Try nyo lang, ha? Try nyo lang. Kasi ang concept nito, class, alam nyo na eh. Ang concept nito is the present value. How do you get the present value? Okay? Given that you have from year number 3 up to forever, let's assume it's forever, the growth rate will be at 6%. First 2 years, it will be 20%, and then next years will be 6%. Okay, so please, okay, give me the price now, the estimated price now, the stock valuation, the value now, given your dividends. All right, I'll give you, say, 5 minutes, class, for this. Let's compare notes. What will be the price of this stock? So this is just an application of the time value of money. All right, so let me do it, and I expect you to try. Okay, pause share muna ako. Pause recording lang ako, ha. Please remind me. Okay, thank you, Luis, for sharing your answer, 28.07. Okay, how about the others? James, what answer are you getting? James?
Sir, wala pa po akong answer.
Wala pang answer? Tagal naman ang present value na yan. Gerard, may answer na? Gerard? Wala yata mic si Gerard ngayon. Okay, how about Chilean? Jillian?
Still trying to figure out the
Wala pang final answer?
Wala pa.
Kathleen? Okay. So Carlos, could you kindly share your screen and me?
All right, sir.
Stop share ko. Okay, let's see how you did it.
Oh, sir, I wasn't able to finish it po because I had a hard time following.
Yeah, it's okay. So, say Luis. Luis, could you kindly share your screen? All right, sige. Kindly explain kung anong ginawa mo.
Okay, sir. So, yung 0.6, yan yung dividend. Tapos, ginawa ko na lang, sorry. Yeah, this is 1 year ahead. Tapos, ano pa lang to, future value based on the growth rates. And then I calculated for the present value here.
Okay.
hindi lang ako sure sa terminal value.
Mhm.
Diretso ko na lang.
Yeah.
Feel ko
Okay.
mali to.
Yeah.
And I added everything.
Okay. So your final answer is 28.
Yes.
Okay. Okay. Thank you, Luis. So you get plus 3 points dun sa quiz natin. Remind me. And thank you for taking the courage and sharing your answer. Okay. So plus 3 points for Luis for sharing with us his answer. Okay. So let me share now. But the idea is okay. So pero let's just see. Okay, share screen ako. All right. Can you see my screen, class? Can you see my screen now? Hello, class.
Yes, sir.
Okay. All right. So we're told that the dividend now is 1.6. So it's best to plot your cash flow on your timeline. The dividend now at year zero, D0 is 1.6. Okay, so this will not figure in the determination of the stock price kasi historical na to eh. Nabigay na tong dividends na to. Okay, and then for the first 2 years, it will be 20%. I just copied this. So plot yung growth rate, no? D16, $16, so that I can copy to the next one. $16. And then from year 3, you have 6%. So infinite yan. You can just continue with the 6%. Right? If you're manually computing this, you get the present value of this annuity of 6%, right? At this point. Okay, para maging annuity ordinary siya at the end of the period. All right, so and then what will be the growth rate? So just one formula, no? Kasi andyan na naman yung mga percent eh. So it's equal to the previous times 1 plus the growth rate. So I'm using only one formula and then I can copy this to the right. Kasi above I have the growth rates. I place the growth rates above. Okay, so that I'll just use one formula and then copy to the right. Okay, so in principle, the value of a stock now will be equal to the present values of their future dividends. So the future dividends start with this one, right? This is dividend at time zero. So this will not figure anymore in the price of the stock. Kasi in a sense, historical na to, na-distribute na to. So we're talking of future dividends. So starting with dividend at year 1. And then it's expected to grow for the next 2 years by 20%. And then for the next, after that, will be, okay, 6%, no? 6% na siya after starting with year 3. Okay, let me just set up my digital pen. I think I can. All right. So, okay, lang a second. Gosh. Hindi pala naka. Let me link my digital pen. Okay. All right. The question is, what's the present value of this stream of cash flows from year 1 until year whatever, no? Infinity, kasi constant, it will be 6% for the next X years. Now we know, class, that even if you put here 6% up to 1,000, okay, the further you go from the present value, okay, from now, the lower will be the present value of this, even if this keeps on increasing over time, because it will increase by 6% every year. However, since it's already very, very far from today, okay, the present values of these cash flows will reach a value of approximately 0. Okay, for example, So, anong year na to? Let me copy this. If you're taking a look at, okay, let's just illustrate this. 60 years from now, the dividend is expected to be 95.95. If I get the present value of this, okay, let's name ourselves. Okay. Okay, let me use this. Control Shift F3. Okay, the names are on the left column. All right, so I gave names to this one. This is RS, required return. This is growth rate, short period, growth rate, long period. This is our dividend at year 0, D0. Okay, if I compute for the present value of this, okay, let me dramatize the point more. Okay, so I'm going to copy this. Okay, if we reach up to year 114, you can see that the constant growth rate of 6% will give us a very high, quite relatively high dividend. But if we just compute for the present value of this, PV, our rate is RS, right? Required return. And then comma, okay, let me increase the size of that so that you can see. I'm going to compute for the present value, negative PV. Our rate is RS, there. Comma, our NPER is 114 here. No PMT. Our future value is this one, 1573. And then the type ignore. So what's the equivalent present value? What's the present value of 1,573 pesos now in 114 years? Let's see what's the present value of this. So it's just 3 centavos. Okay? 3 centavos. So if we go further, we know that this will really diminish. The present value will keep on going down until such time na practically zero na siya. Ay, nakamute ba ako? Sorry. No, hindi ako nakamute. You can't hear me, class? Can you hear me?
We can hear you po.
Okay. Oh, Luis, ba't hindi mo ako marinig? I'm not in mute mode. Okay. All right. Can you hear me now, Luis? Hello? Parang may problema yung yung microphone or earphone. Kasi kanina medyo choppy din yung when you were discussing. Okay. All right. So this tells us that the further we go, whether it doesn't matter if you use 1,000 years. You might think that if I use 1,000 years, then the present value will become bigger. Not so fast, no? Because as you go out in the time horizon, the present value of that becomes very negligible. I can continue with this up to 2,000, 1,000. So, and practically the present value will become zero. Okay? All right. So, it can be estimated, okay? Okay, let me write that. So for a constant growth rate, let's draw that, Okay, let me use this. The value, the price of a stock, P sub O, that's the price now, will be equal to the dividend, dividend at year 1, divided by your required return, R, minus your growth rate. This is called your dividend growth rate model, constant growth rate model. So this is just equal to whatever your dividend now, and then you let it grow by your growth rate divided by your R minus your G. Okay? Dividend 1 is equal to D sub O times 1 plus G. Now the question is, when will the constant growth rate begin? Okay, when will our constant growth rate begin? Class. When will it begin? On year, period 3, right? The constant growth rate will begin on period 3. Therefore, if it begins on period 3, we can substitute, okay? We can substitute. Let me use this. Starting with year 3, we can substitute all of these cash flows from year 3 until infinity. We can substitute it by one cash flow at year 2, D2. So all of these dividends at year 3, year 4, year 5, those that experience constant growth rate model, we can compute the dividends on year 2, okay? And replace all of this stream of future dividends with just one value, this D2. So let me repeat that. Okay, assuming that the constant growth rate starts at period 1, then you can compute for the price or the dividend at period 0, okay, by using this formula. D1, where period 1 is the period where the constant growth rate will start, and then divided by the required return minus the growth rate. Okay, so in this case, the constant dividend will start in D3. Okay, so D3 up to infinity. So we can replace the dividends from year 3 up to infinity with just one. And that's a dividend at period 2. And that formula is equal to D2 is equal to the dividend at year 3 divided by R minus G, which is equal to the dividend at year 2. We let it grow by 1 plus G, right? Because D3 is equal to D2 times 1 plus G, times the constant growth rate of 6%. And then we divide this by R minus G. Okay, so that's the formula. You first take note of where the constant growth rate begins. So here the constant growth rate begins at year 3. Therefore, you can say that we can replace all of these dividends from year 3 up to infinity with just one value, D2. Okay, take note of that, please. Okay, we replace all the dividends from year 3 up. Sorry if I keep on repeating this, but this is a concept where students often make a mistake. Okay, so what are we going to do with the dividends from year 3 up? We're going to replace it with just one dividend, D2. Okay, why D2? Because the constant growth rate begins on D3. So let's replace all of these values with an equivalent D2 value. Okay, so the D2 will be equal to, okay, a D2, the dividend. What I mean by D2 here is, what's the replacement for all of this? Because you have a dividend here, D2. Okay, so another D2 is the equivalent of all these dividends. So that will be equal to, so just to, okay, maybe let's call this D2 star, just to distinguish it from the D2 here. So the D2 star is equal to D2, this dividend at year 2. We let it grow by how much? How many percent, class? How many percent? Hello? How many percent? Plus, how many percent? What's your constant growth rate? No, not 20%. Take a look at this one. Constant growth rate. Okay? Constant growth rate. You can only use this model, class, if the growth rate is constant. 20% cannot be because it's not constant. 20% will only be for the next 2 years. Okay? 2 years lang yung 20%. The rest will be from third year. It will be 6% up to whenever. Okay, constant na siya, no? Okay, so what we can only replace is the constant growth rate from year 3 up to infinity. Okay, please take note that this formula is only good for a constant growth rate from the year. The constant growth rate begins up to infinity, okay? We cannot use 20%, 20% because this is not infinite. It's only for 2 years. Clear yan, Kas? Pakichat nga please kung clear. Pakichat please kung clear siya. Okay. Let me repeat, class, ha? Yung constant growth rate, yung equivalent value ng dividends, okay, we're replacing D3, D4, D5 up to D infinity with one value. Ano yung value na yon? It's a dividend of the previous value of the previous year. Okay? So we will call it D2 star to distinguish it from a dividend at year 2. Kasi meron din dividend at year 2, no? Itong 2304, which was obtained by allowing D1, which is 1.92, to grow by 20%. Okay? And then there's another dividend on year 2, which I'm calling D2 star, okay? Which is the equivalent dividend for all the dividends from year 3 up to infinity. And why can we do that? Because it has a constant growth rate model. It has a constant growth rate. Okay, we can show mathematically, pero siguro next meeting na natin. So ipakita na lang mathematically, but I'll do that next meeting, no? Okay, that you can add all these dividends. D2, D3, D4, their formulas are D3 is equal to D2 times 1 plus G. D4 is equal to D3 times 1 plus G. What is D6? D6 is equal to D5 times 1 plus G. Okay, we can show that, okay, all of these dividends starting with year 3, which experiences constant growth rate, okay, up to infinity yan, it can be replaced just by one value, D2, the dividend on the previous year. Okay, I'll call it D2 star, which is equal to, what is it equal to? Whatever D2 is now, times 1 plus, you let it grow by G. Okay, why are we multiplying D2 by, okay, saan yung, why are we multiplying D2 by 1 plus G? Why are we doing this? Kasi yung formula, class, the equivalent D2, let me call it star, is equal to the dividend at year 3. Okay? The dividend at year 3 is equal to your D2, whatever your dividend for year 2 is, multiplied by 1 plus G. You let it grow by G, right? The constant growth rate. All right? And then we divide by required return minus the growth rate. So in this case, the required return should be greater than your growth rate. So we cannot have a scenario where your required return is less than your growth rate, because that will give us a negative dividend, and that's not possible. Okay, we cannot have your required return less than your growth rate because it will give us a negative dividend, okay, which is not possible. All right, so that's your constant growth rate model. So it doesn't matter whether you have an infinite stream of dividends from whatever year, up to the future. You can just replace it with one equivalent value, which is the dividend of the previous year, okay, which is equal to this formula. Okay, can you please now compute for the equivalent D2 star dividend? Okay, so this is a pretty straightforward formula. It's just D2. What's your D2? This one. And then you multiply it by 1 plus G, and then divide it by your R minus G. Okay, I'll wait for you to chat, please, what answer you're getting. Kindly chat, please. What is the value of the dividends? We're only at dividends, class. No? We're only at dividends. Let me erase this. Okay, how much? Waiting for your answer, class. No answer yet, class? Follow the dividend discount model. Okay, but first you have to set this up, no? You have to know the dividend on year 1, year 2, okay? And then the growth rate changes. It's now 6%. That's why it's instructive to write your growth rate above so that you can easily determine the dividends for each respective year. Answer, please. Kindly chat your answer, please. What value are you getting? So my question is, after you have set up this dividends, and you notice, of course, it will increase over time. Because it's growing by 6% every year, right? In fact, when we reach year 114, after 114 years, it will already be, the dividend will be equivalent to 1573. Okay, we can get, of course, the present values of each. Okay, let's see. No, my question is this one. You have this dividend, right? Dividends from year 3 up to infinity. The question is, how much is the equivalent cash flow, dividend cash flow, of the dividends from year 3 up to year infinity? How much is the equivalent at year 2, the D2? Technically, the D2 star. What is its equivalent value? Anyone? Just follow the formula, class. Follow the formula. I'm not getting any chats from you. I'll wait until you're able to answer. Kasi andyan na yung formula, susundan nyo lang to, class. Okay, we have one answer here. Reference. Ba't kaya reference? Balikan natin, Carlos, mamaya yan. Check your formula. Kasi ito lang naman yung formula, di ba? Ito lang, oh. This is just a formula, very easy. Multiplication, division lang siya. Addition, subtraction. Andyan si MDAS. No? It's just the product and the quotient. You should be getting one answer. No? Do we know D2? Do we know the growth rate? 42.4. Okay, we'll request Luis to share his screen. Okay, let's give a few more seconds to the others. Only one? Come on, class, you can do this. Okay. Another one, answer. 24.36 naman. Okay. So I'm waiting for the others, please. I'll give you a few more seconds. Just key in your answers, please. Sige, let me request Rhea naman to share her screen. I'll stop share. Rhea, could you tell us how you got your 24 something?
Wait lang. Ay, should I just ilagay ko na lang po yung ano, yung wait, wait, sige. Screen share ko po. So, I'm not sure.
Sige lang.
Sige po, wait, sir.
You will not be faulted for that.
This
Okay.
one, sir.
Sige. How did you get that?
From yung formula po, which is dito, so I just took yung dito and I
Okay.
multiplied by, I believe it was 1 plus yung, was it the G po, which is this one, the growth rate po,
Okay.
which is 6%. And then divide that po, which is yung required returns po, yung 10
Okay.
minus yung growth rate po ulit.
Okay. All right. So, ang mali lang dyan, tama naman yung concept ng formula. Kaso, nagkamali sa parenthesis, no?
Oh, okay. So wait.
Bakit? Bakit nagkamali sa parenthesis? So you have your numerator. After you get the answer sa numerator, what do? We divide by D15 only. And then after you divide by D15, you subtract D17.
Okay, sir.
But the formula is dividing by the difference between D15 minus D17, ba?
Yes, sir.
Okay, so what do we do with that? Simple change lang yan. Sige, answer?
Yes.
Okay, yeah, no? 61.05. Okay, so that's the answer, no? Sige, let me share screen and let me discuss that. Okay, so the answer is 61. Andito na, class, oh. Andito na. Okay, so let's do this. We want to replace all of your cash flows from dividends from year 3 up. Now, why year 3? Why are we replacing D3 dividends from year 3 up to infinity? Because that's the period where your constant growth rate begins. All right, from D3, from year 3 up, your constant growth begins 6%. So as I said, where the constant growth rate begins, you can replace it with the value before that particular year by using this formula. So it's equal to the dividend on year 3, okay, this one, or it's also equal to the dividend at year 2 plus 1 plus 6%, right? Because the dividend at year 3 is equal to whatever the dividend on year 2 is, and then we let it grow by the constant growth rate, 6%. Okay, so you can just take a look at this. Sorry. This one, this is dividend on year 2 times 1 plus G. That's why I said it's instructive to put the growth rates on top. No? Para mas madali. Isang formula lang, copy to the right. Tapos. All right. So this is the dividend at year 3. So either I use this one, dividend at year 2 times 1 plus G times 1 plus 6%, or I directly use this because it's the same. No? It's the same. So if I compute for that, this is equal to either I use this dividend at year 2. Okay, hindi niya ma-access. Dividend at year 2. Ulit. Daming sulat. Dividend at year 2, right? F20 on. And then I multiply that by times 1 plus the growth rate, which is your GS, right? That's your GS. So I'm letting it grow by 1 plus the small short growth term, and then divide it by. Okay, so dito nagkamali sila yan, no? Dapat yung denominator, ipaparenthesis natin. Otherwise, i-divide niya muna yung unang number, yung R sub S. Tapos sa kanya, ima-minus yung G. But the divisor should be the difference between R sub S minus G. R sub S, okay, minus, ano yung G dito? Yung constant growth rate, which is G or GL. Okay? That's your GL. That's your constant growth rate. Okay? Control Enter. So I'm now able to, okay, bakit magkaiba siya? Let me see. F20. Ay, tama ba yung F20 ko? Okay. Dito kasi class, kinuha natin yung dividend year 3 divided by R sub S. May mali yata ako dito. Tama, R sub S D15 minus D17. Okay? So if we divide this, we get, kasi dividend on year 3 divided by the difference between G sub growth, the required return minus the growth long term, GL. So yun, no? D15 minus D17, which we gave a name to already. All right, so let me repeat it here. Bakit 69.12? Okay, ulitin ko. Dapat pareho yan. No? Is equal to?
Sir,
Yes.
sir, GL po dapat, not GS po.
GS na gamit ko? Okay, sige. Thank you. All right, thank you. So again, dividend at year 2, okay? Then we have to get dividend at year 3. So 1 plus, this is now your GS, diba? Your short-term growth rate divided by R sub S, that's your required return, minus your constant growth rate. You're correct. Your constant growth rate is GL, right? Long-term GL. Close this. Okay. Control Enter. 69 point. Bakit ano? Tama ba yung GL ko? Tama naman. Yeah, this is GL. This is my RS. Bakit? Why am I getting 69.2?
Sir, GS po yung nakalagay po sa 1 plus GS. Dapat GL po, sir.
Ay, oo. Tama. Yes. GL, no? Kasi yung growth rate natin for dividend 3 is the start of your long term. Thank you. Yeah, thank you. GL dapat. Kasi yung growth rate natin sa dividend 3 is the start of your long term, di ba? So 6% yan. Okay, so magkapareho dapat yung G dito sa numerator at saka G sa denominator. Okay, so my mistake. All right, so I'm getting now the correct answer. 61.056. Okay, so what do we have now? The dividend, the price of the stock will be equal to the present value of the future dividends. So, ano yung mga dividends natin? We have the dividend on year 1, we have the dividend on year 2, we have the equivalent dividend for the constant growth rate. No? So we just get the present values of it. It's equal to negative PV. Okay, negative PV. Our rate is RS. N per is 1 here, comma. No PMT. Future value is 1.92. Okay, so the present value of that is 1.77, 1.75. Ito naman 2.3, this will be equal to negative PV. PV again, our rate is RS, comma, di natin pwedeng maano, no? Wait. RS, comma, our N per is 2. comma, no PMT, future value is 2.3. All right. Type ignore, control enter. So the present value of 2.3 is 1.9. And lastly, ito pa. Okay, because we have effectively converted all of these dividends into one dividend, diba? Itong 61. So kunin natin yung present value niyan, negative PV. All right, rate is RS, comma, N per is 2 din, no? 2. No PMT, future value is 61.056. Ignore the type. Enter. So 50.46. All right. Question. What will be the present value? Can we now add this? Chat yes or no, please. Can we now add this? Okay. Yung iba ang tagal sumagot. Can we now add this? Thank you, Luis. How about the others? Oh, calling James, calling Rhea, yung iba. Calling Carlos, calling Gerald. Yeah, thank you. Oh, Gerald, James, why can we add this? Why can we add this dividends?
Sir, kasi po present value po siya.
Yes, thank you. That's good. Tama, present value na sila. No? So we can now add them. All right? So just get the sum is equal to sum of all of these present values of your dividends. Okay? Tanggalin natin dollar, control 1, a number. Just 2 decimal places. All right, so it's 54.11. Okay. All right, so that's how we estimate the stock price using future dividends. There are other ways. As I mentioned a while ago, we can use the free cash flow. So it depends on what the available data for the company is. If it's a publicly listed company, and if it generates dividends, issue dividends regularly, then we can make use of that information. All right. So once again, let me just summarize what we have done. First, we compute the dividends given the estimated dividends. So for the next 2 years, the short-term growth is 20%. So basing on the dividends now, we can compute for the dividends at year 1 and year 2. Okay, and then starting with year 3 will be your constant growth rate. And it's estimated to be growing at 6%. All right? So here, the constant growth rate starts with year 3 up to infinity. Okay? So what we can do is replace this stream of future dividends starting with year 3 with a dividend on year 2, the previous year, using this formula. And this is your Gordon model. Okay, the one that I mentioned a while ago. This is your constant growth rate or the Gordon model. All right? So once we have converted this infinite stream of dividends into just one value, D2, okay, then it leaves us with just 3 dividends, one in year 1, another one in year 2, 2 in year 2. So we could have just added this. No? We could have added 2.3 and 61.5. We can add them because they all belong to year 2. And then just get the present value of them. All right? Is that correct, class? We could have added 2.304 and then 61.056 and get its present value. Was that correct, class? Kindly chat, please. Tama ba yun, class? Class, come on. Tama ba yun? I could have added 2.304 and 61.056. Hello, class. Will it give us the same answer? Class, come on, come on. You can do better than that. You can answer that question very easily. Can I just add the dividends, class? Hello? Why no answer? No? Why no, Gerald? No, the answer is yes. Well, yes, they belong both to time 2, right? If the cash flows belong to the same time frame, then we can add them. Okay, not only the present values, so if the cash flow belong to year 8, for example, we can add those cash flows that all happen on year 8. Okay? All right, so if I, for example, add this to sum of this dividend and 2.3, so that's 63.36, okay? So let me add this. What's the sum of 1.9 and 50.46? So the sum of the dividends for year 2, the present values is 52.36. So let me also get the negative PV. The present value of rate is RS, comma, no PMT, N per is 2, comma, no PMT, and the future value is 63.36. Okay. All right, class. Are they the same? Are
Yes,
they the
sir.
same, class? Yes, they're the same. Okay. So please don't forget that. And I was just worried because it took you some time to answer, and some of you did not even respond. Okay, you can add cash flows belonging to different time. For example, year 4, if you have several cash flows here, you can add them for as long as they all belong to time 4. Okay? Ito time 3. Can we add them? Yes. Yes. In fact, it facilitates everything because you just have one cash flow here. So you just get one present value. And we got 52.36, which is just equivalent to adding these two present values, which we took separately, although they belong to the same year. Right, class? May I have your confirmation if that's clear, please? Paki-chat nga kung clear yung concept na yun. Please do not forget that, no? Simple, matagal nang inaano natin yan, no? Matagal nang sinasabi natin yung concept ng time value of money, that we cannot add cash flows that belong to different years. Ergo, we can add cash flows that belong to the same year. Diba? All right. So you can, of course, answer this now. Ito expected dividend yield is simply your D1 divided by your price at time 0. Your D1 is 1.92 divided by the price, which is 54.11. Okay, so let me just show this. And then the rest of the questions there, the expected capital gains yield, I'll let you answer that. And then we'll just compare answers next week. Okay? Sorry. So the price is 54.11. Okay, this one is the dividend in year 1 is 1.92. Okay, naka-dollar, sorry. Control 1, numbers, 2 decimal places. So this is the dividend at year 1. This is the price at year 0. The yield, the dividend yield is this. Dividend at 1 divided by the price at 0. So it's 3.55%. Okay? So kindly answer this one. Yung mga susunod na konting question na lang naman yan, no? Okay. So it's, wala na tayong time. I will not start with this one, class, because this will cover some minutes. All right. Your assignment is to, okay, take a look at these formulas. Okay, how is the weighted average cost of capital computed? So let me just introduce this by taking a look at the initial explanation. So your firm's balance sheet is composed of this one, current assets and long-term assets and fixed assets, with current liabilities and long-term debt and equity. All right. So the firm's cost of capital or capital structure revolves around this one. Ito kasi, this is your working capital. Okay? Now, in computing for the capital structure or the cost of capital, we make use of this, yung fixed assets at saka yung long-term debt and equity. But sometimes, kung maliit lang naman current assets relative to your fixed assets, ginagamit na rin yung buo. Okay, so what we're interested in is computing for your weighted cost, average cost of capital. All right? So we're going to, next meeting, we're going to look at the after-tax cost of debt, A sub D, and then the cost of preferred stock, and then the cost of common stock. Okay? Cost of common equity. And then we're going to compute for the weighted average cost of capital. So worksheet number 5 is all about that. Worksheet number 6 is also the same. So there are 2 worksheets for that. And then we're going to look at investment opportunity schedules. We're going to use the IRR, internal rate of return, and then the weighted marginal cost of capital. Okay, so I think on Friday, we'll be able to complete this. Okay? All right, any questions? And some of you have been asking me if next week will be face-to-face. Some of you are going already to the province, or so we'll just have online classes next week. Okay, for Tuesday and also for Friday. 3 o'clock sa Friday. Hello? Yeah, sure. I'm going to, let me check. No? Have I loaded the other modules natin? Ano yung last video na na-load ko? Hindi ko na-load yung yung previous one. Efficient Frontier, yeah. I think may mga videos ako na hindi pa na-upload. Okay, so I'll upload this and the previous one. Okay? Let me stop share first. Stop